Chairman of the International Committee, CA Sanjeev Kumar Chaudhary, Vice Chairman of both the committees, of course, Mr. N.K. Hegde, Mr. Sushil Agarwal, Central Council Member, Mr. Tarun Kia, of course, you have just heard him, and of course, Jai Chariji, and friends. Let me tell you, friends, I was expecting more, but there are only 53 amendments which have been brought. Don't think there are only 53. There may be, the 53 sections have been touched, but there may be a particular section where there will be more than one change also. So I'll take clause by clause whatever I could remember at the moment. I'll take with you. The first change, of course, is in section 2. Section 2, clause 22's explanation has been inserted as a 2A. I'll take up that later when I come to 115O. Section 2, clause 24, definition of income is an inclusive definition for income. I will take up this inclusive definition when I refer to you section 28 and 56, why this has been introduced. And the another is section 2, clause 42A, period of holding of a capital asset. That I will take up when I come to conversion of what you call inventory into stock capital asset. We'll be doing that also. That is under section 2. Section 9 has been very well dealt with by Mr. Hegde, so I may not repeat that again. Then I come to section 10. There are many changes in section 10, but a small change in section 10, 6D, I may not take up because it is for National Technical Research Organization. The income is exempt if they pay royalty to a non-resident, the income of a non-resident for getting that royalty or fee for technical services. Whether services are rendered in India or outside India to a non-national technical organization will be exempt in their hands. So there's not much. Coming to now section 1012A. You remember, in case of an employee, 2 years back, 1012A was introduced that whenever a person, employee opts out of the National Pensions Trust, or that is scheme, or he ceases to remain the member of that scheme, he wants to close that scheme, 40% of the amount received by the employee was exempt under 1012A 2 years back. Last year 1012B was inserted, that too was for employee for partial withdrawal. But what happened for those persons who are self-employed and they have also contributed to National Pension Scheme? If they withdraw, if they close down the scheme, if they want to opt out of the scheme, the exemption was not there. Now section 12A has been amended, 1012A has been amended, saying that instead of the word employee, now the exemption will be for any assessee. Assessee means whether employee or self-employed person who has contributed to National Pension Scheme, when he opts out of this scheme or he closes down the scheme, 40% of the amount which he receives shall be exempt in his hands for all assessee now, not for only employee. That is the basic point which I wanted to tell you. You must have heard the finance minister telling on the TV regarding charitable trust. You know that charitable trusts do not carry on any business. We have a section called 40A giving disallowance of TDS not deducted to the extent of 30% if you don't deduct the TDS. Or we have a 40A3 section also, the payment of an expenditure exceeding rupees 10,000 a day should be paid by an account paid check or account paid draft or electronic clearing system. But that is only for business. What about the charitable trust? They don't carry on a business. So what I have done, section 1023C they have inserted a proviso. In section 11.1 they have inserted an explanation saying that the provisions of section 40A and section 40A3 and 3A shall also be applicable in case of such charitable trust. Meaning thereby, if a charitable trust covered under 1023C or section 11 does not deduct the tax, the disallowance will be to the extent of 30% of the amount so claimed as expenditure, means as application, obviously as application. And that please note, 30% will be disallowed. Now 48.3, if there is a payment, you are applying the funds and there is a payment exceeding 10,000. Now it will have to be made by way of account paid check or account paid draft or electronic clearing system. Failing which, whether it is a revenue expenditure or a capital expenditure, the amount will not be allowed as deduction. 48(3), please, the amendment has taken place in inserting explanation or a proviso, but those provisions have been imported in this section also. So be careful now, TDS to be deducted, otherwise 30% will be disallowed, payment to be made by account paid check or account paid draft, otherwise that expense will not be treated as an application of an income. That expense will not be treated as an application of income. Next point is section 16. 2006-7, standard deduction was abolished. And I have been trying right from that time that this standard deduction should be reintroduced. Nobody was listening to me. Nobody was listening. They say, why this reduction to be allowed to the salaried employee when it is not allowed to the businessman? Gradually, they allowed first 800 rupees for transport allowance, which was raised to 1600 rupees later on. So 1600 multiplied by 12, 19,200 was the transport allowance for commuting from residence to the office and back. And of course, there was a proviso given under section 17(2) also that reimbursement of medical expenses shall also be allowed as deduction subject to the maximum of rupees 15,000. Maximum of rupees 15,000. Now, you may think it is good, but these two have been done away with. Now, no transport allowance exemption separate, no medical reimbursement of 15,000 tax-free. Now it has been merged into section 16I, which was a standard deduction at that particular point of time, reintroduced, and the amount allowed shall be the amount of the standard, the amount of the salary, or rupees 40,000, whichever is less. So the maximum is 40. So net benefit is only 5,800. Because if you were getting like an ek advantage, you will not have to take a bogus bill of now medical reimbursement. Earlier people were taking bogus bill of the medical reimbursement, buying medicine and all that to claim 15,000 rupees and giving to the employer. Now no need to take any bogus bill. Standard deduction. You fall in or you don't fall in. You travel or you don't travel. You travel by 1 kilometer or you travel 10 kilometers. You travel by car, you travel by anything. Now there is a standard deduction of 40,000. So, becoming honest now. The salary employee will also become honest. Why have that bogus bill of 15,000 of reimbursement of medical expenses? So that is a good point which I would say. But 17, of course, I have told you 15 is gone. Now 28 section. 2 amendments have been brought in 28 section. Now sometimes you receive from any person a compensation by whatever name called. The compensation is on account of termination or modification of the terms of the contract of terms or condition of a contract relating to business. Somebody was saying it is a capital receipt, somebody used to say it is a revenue receipt. Now they have very clearly said under section 28 clause 1(2)(I), they have included that whenever you get this compensation by whatever name called for termination or modification of the terms and condition of the contract relating to the business, that will be treated as business income. Business income, it will not be treated as capital receipt. It will be fully taxable. Second point, very important point. We have section 45(2) under capital gain saying conversion of a capital asset into stock in trade is a transfer. Conversion of capital asset into stock in trade. But that transfer, it is a transfer, but the capital gain does not arise in the year of transfer. The capital gain arises in the year in which the transferred asset is sold or otherwise transferred. At that time, there are 2 types of gain. One is called the capital gain, fair market value on the date of conversion minus the cost of acquisition or index cost of acquisition. And second, of course, is the business income, that is sale price minus the market value as on the date of conversion. But there was no provision regarding conversion of an inventory into a capital asset. Conversion of inventory into a capital, there was certain judgment, but it was not clear. Now they have inserted a clause under section 28, clause VI, saying that fair market value of the inventory on the date of conversion, the fair market value of the inventory on the date of conversion into capital asset shall be treated as business income. Please note, the capital gain is not postponed. Even if we have not sold that asset, this will be treated as income of the previous year in which that inventory has been converted into capital asset. Same is not the position under 45(2), but here it will be treated as income of that particular year, and that is the fair market value. And fair market value procedure will be done. How to determine the fair market value, that of course will be there. Next section. You must have heard about from them that income computation standards, which were Mr. Chaudhary sir saying, which was there, a stay order was given by the High Court saying that they cannot do it by buying a circular or a notification. It is not allowed. But now they have inserted all the provisions under business chapter, saying that they have inserted 43AA. They have inserted section 43, they have inserted section 43CB, saying that income computation standard, whatever will be, and they have put a 40 capital A also, that this expense will not be allowed as deduction. But only thing is, mark-to-market losses, which is prescribed, will be allowed to you under section 36 of section 1. That will be allowed, otherwise those things, whatever income computation standard, now they have been incorporated in the Income Tax Act, you will have to follow that. Dispute which he has already mentioned, those who have already filed the return, what will happen to them is going to be there. Let us see, we will put up a post-budget, of course the institute always give the post-budget memorandum, and we will do right about these things here at that particular point of time. Coming to now, Mr. Tarun Ghia had pointed out, it was 43CA, 50 capital C, and 56 subsection 2 clause X, that is 10. You remember, 50C was where the consideration from the transfer of any land or building or both is less than the stamp duty value fixed by the authority. Then for the purpose of computing capital gain, the stamp duty shall be deemed to be the consideration, deemed consideration. And this is also in 43CA, even if it is a stock in trade of land and building, and you are selling for a less than the stamp duty price, then the deemed consideration for purpose of computing business income was the stamp duty value assessed also. And there was a tax in the hands of the recipient also under section 56, section 2, clause 10, saying that if the difference between the market value, stamp duty value and the purchase price is more than 50,000, the balance will be treated as income under the head other sources. This was the section under 56 to 10. Now what they have done? They have now said, please note the word, if the stamp duty value assessed does not exceed 105% of the actual consideration. Please, 105%, that 5% Mr. Tarun Ghia said is correct. But that 5% is not to be calculated from the stamp duty value. 5% of the actual consideration. Suppose the actual consideration is 100 crore. So maximum allowed is 5% of 100 crore, 105. If the stamp duty value is 105 or less than 105, we'll take consideration as 100 crore. But if the stamp duty value is more than 105, 105% of the actual consideration, then we will take the stamp duty value. Same in 43CA, same will be in 50C, but in 5627, because there is a difference of 50,000, now they say 50,000 or 5%. Whichever is higher. That of course is the difference. Then they will not treat as income. But if it is more than that difference, it will be treated as income under the head other sources. So 43CA read with section 50C and also read with 56 to 10. I have told you that is the difference. Next section. 44AE. We all know that in the case of a transfer who do not own more than 10 trucks, the presumptive income was to be calculated at the rate of 7,500 per month or part of the month for each goods vehicle with you. Now they say that this was only for the persons who were having small transporters, not those who were having heavy goods vehicles. Now they have changed the presumptive income, that if you have a heavy goods vehicle of 12 metric ton, gross weight, vehicle weight 12 metric ton, or laden weight or more than 12 metric ton, then the calculation of that vehicle will not be 7,500 per month. It will be 1,000 per ton per metric ton for part or full labor. So if it is 12 metric ton, 12,000 per year, 12,000 per month. If it is 14 metric ton, 14,000 per month, the goods vehicle weight. If it is 16 metric ton, 16,000 per month, plus for all other goods vehicle which are less than 12 metric ton, of course it will be 7,500 per month or part of the month. This is under 44 AE, the change has been made. Very rightly pointed out. But I will speak out the section 54 EC. What was the section? Any long-term capital gain arising to any assessee from the transfer of any capital asset was exempt to the extent such capital gain is invested in the bonds, prescribed bond, National Highway Authority, Rural Electrification Corporation or any other defined bond, subject to a maximum of rupees 50 lakh. And the period of bond lock-in period was 3 years. Now, what is the change? Please note the word. Any long-term capital gain arising to any assessee from the transfer of any asset, any land or building or both. Please note, from next year it is only land or building or both, you will get 54 EC. You transfer jewelry, you get share, you don't get 54 EC. You'll get 54 EC only for land and building and 50 lakh of course. But please, the lock-in period will not be 3 years now. The lock-in period will be 5 years. 5 years. So 5 years is the lock-in period for which you will get exemption of long-term capital gain. Careful. So this is 54 EC where the change has taken place. I've already spoken to you about 56, but there is one term in 56 also added in 28. There is a contract of employment and there is a modification of the terms and conditions of employment, or there is a termination and you get compensation. Now that compensation will be taxable under section 56, subsection 2, clause XI. They will not tax it under that point. It will not be treated as a capital receipt or anything. So this is another change which has taken place. Very good change. Because of insolvency thing, we had demanded that. 79 section. Last year, section 79 of carry forward the losses of the non-listed company, closely held company. You had to have 51% shareholding. That should continue as the same person. But last year for startup, the 51% clause was not there. They should continue to hold the share, but the 51% holding was not there. What about this insolvency? That's the IBC. When this insolvency provision takes place, somebody else buy the company. Now, when they buy the company, I'm talking about closely held, not the widely held. The closely held company is bought under the insolvency provision. They have taken loan and it's been bought. Somebody else has become the shareholder. So what about 151% shareholding? Can they continue? They cannot. So that provision will not be applicable in case they are under insolvency provision. That provision will not be applicable. 79 section not meant for that. Meaning thereby, so if I am buying under insolvency provision, I need not have a 51% shareholding by the same person. There is no need. That is 79. Next change. Mr. Tarun Gaya pointed out 80AC was a section where you were supposed to file a return of income if you have to claim deduction under ATIA, ATIB, ATIC, ATID and ATIE. This was only up to ATIE. But there is part C of section 80 which starts from ATI and goes up to ATRRB. ATRRB, like ATQQA, author gets a 3 lakh, ATQRRB, a patent getting deduction of 3 lakh, ATP, what you call a cooperative society getting a deduction. Now for all incomes for which deduction is allowed under part C, please starting from ATIA and ending to ATRRB, they will not be allowed a deduction under these section unless they furnish their return of income on or before the due date mentioned under 139(1). Be careful now if you have to claim deduction, like a person like me, if I want to delay and I want to claim a deduction of author, 3 lakh rupees. I will not be allowed a deduction of 3 lakh now. If I file a return, at a later date. Otherwise, it is advisable to file now return on time. Why I am saying on time? Because otherwise you will be liable to a fine of rupees 5,000 from next year and 10,000 if you file after 31st December. So it is better to file a return, sir. It is better. Now you will have to do it. So that is the point. 80AC I've done. 80D, a good, wonderful change for senior citizen like me. I would say like me. Why should I tell you about the others? There are other senior citizens also. The senior citizen 80D, where the deduction was allowed for payment for medical aid, was allowed to the extent of 30,000 for a senior citizen, either paid by himself or paid by his children. You could pay for your parents who are senior citizen, or you could pay for yourself or your spouse or your family. 30,000 were allowed for senior citizen. For very senior citizen, the case was you were allowed, if you are insured, 30,000. If you are not insured, medical expenditure incurred was allowed as 30,000. Now, wonderful change. First, this 30,000 has been raised to 50,000. Second, the concept of very senior citizen done away with. Means anybody who is above 60, if he is insured, he gets 30,000 of medical claim. But if he is not insured or he cannot be insured, he incurs expenditure on his medical treatment, still he will get a deduction of 50,000. A person like me who is not insured, and now they don't insure me, what should I do? I can't take a deduction. Now I'll be allowed a deduction in spite of the fact I'm not 80, but I will be allowed a deduction of 50,000 rupees of any expenditure incurred by me on my medical treatment. This is a good move for senior citizen. Another move, 80DDB. 80DDB is a treatment of specified ailment or disease for expenditure incurred by the individual for himself or any dependent member, or incurred by the HUF for any member of the dependent member. The question is, there it was a case of 60,000 for senior citizen, and 80,000 for very senior citizen, and 40,000 for less who was not a senior citizen. Medical treatment expenses. Now for senior citizen it was 60, for very senior citizen it is 80. Now the concept of very senior citizen done away with here. The concept of very senior citizen remains only in tax liability, because there it is 5 lakh. But it is gone from here. Now any senior citizen who has gone for treatment for specified ailment or disease, or for his dependent, dependent means brother, sister, spouse, children, these are dependent. Those are dependent on you. They will be dependent on you when you incur expenditure. This 60,000 has been raised to 1 lakh, both for very senior citizen as well as senior citizen. So, but treatment should be of a senior citizen. Why did senior citizen 1 lakh? Otherwise it is 40,000. Coming to next section, 80IAC, startup. You know, you were given a deduction of startup for 100% for a period of 3 years out of the period of 7 years. 3 year, 100% reduction in case of startup for an outer period of 7 years. But this was only for those who started on or after 1/4/2016 and 31st March 2019. Now this period of 19 has been increased to 31st March 2021. So even if you establish by 31st March 21, you will be eligible for a deduction of 100% profit for a period of 3 years out of 7 years, a consecutive period of 3 years out of the 7 years chosen by you. So that is a good move which for startup they have allowed it. 80JJAA. For 80JJAA, you all know, is for employment of new workmen. And the period was that minimum period of 240 days who should be employed in that previous year. But in the case of the person who was engaged in apparel manufacturing, it was a period of 150 days. Now that apparel manufacturing period was only 150 days because there may be a seasonal one come. Now that apparel plus leather goods or shoe industry, it has been raised from 240, it has been brought down to 150 days. 150. For others, 240. Now there was another difficulty. Suppose I employ a person in June, July, August, September, November. He cannot complete 240 days. So since he cannot complete 240 days, I will not get a deduction, because next year will be as per the last year. Increase should be as per the last year. So I will not get a deduction. Now a wonderful thing has happened. If you have employed a person in a previous year for less than 240 days, okay, you will not get deduction for him. But if he continues to be there in the employment next year for 240 days or 150 days as the case be next year, you will get deduction next year for that person. You will get deduction next year for that one. So this is a good move that you may not have to employ it before 31st May, because how can you complete otherwise 240 days? Now you will be able to complete. May not get deduction. I employ in January. Today I employ a person on 1st February. Up to 31st March, there is no question of 240 days or 150 days. I will not get an employment, so I will not keep him. I'll keep him only after 31st March. Otherwise, I will not get a deduction. Now, even if I employ him, no problem. No problem. Since if he is there with me next year for 240 days or 50 days as the case may be, I will get deduction next year. I will get deduction of 30% of the additional employee cost next year. So it is a good proposal. It is a very well thought of proposal, let me tell you. Next year. We have a deduction for cooperative society in case of marketing of agriculture produce of the cooperative society members and all that. Now, but there is a concept of now producer companies. The companies are producing the product of their members. The company is not allowed in deduction. It is only a cooperative society. Now a new section has been inserted under 80PA, saying that where there is a producer company carrying on eligible business and its turnover of that producer company does not exceed 100 crore in the previous year, then if they are carrying on some eligible business, that producer company, 100% of the profit from that eligible business shall be allowed as deduction. Those three businesses are marketing the agricultural produce grown by its members. Second is purchasing the agriculture implements, fertilizers, seeds, etc., intended to be sold to the members. And third is processing of the product of the member, produce of the member, processing. In case of ATP, it is written processing without the aid of power. Here it is not written processing without the aid of power. It is processing of the produce grown by its members. So in the case of a company, now company having members and company in manufacturing the product of the members, produce of the members, processing the produce of the members, or buying implements, feed, seeds, fertilizers for their members, or marketing the agriculture produce of the members. 100% deduction will be allowed to that producer company, provided the turnover does not exceed 100 crore. So it is a good proposal brought in by this under ATPA. Next, wonderful again for me. I don't know whether Mr. Sanjay Agarwal is yet not a senior citizen or the other gentlemen sitting with me, but a wonderful proposal. We had a 80TTA, which was a deduction for interest on saving bank account to the extent of rupees 10,000. It was both for senior or anybody. Now, special section under 80TTB for senior citizen, only for senior citizen. For me, 80TTB. And it is an interest income, not from saving account. Any saving or FDR or recurring deposit with bank, cooperative bank or post office. I will get a deduction of not 10,000, please note 50,000. 50,000 deduction if I have an interest income. Wonderful thing, because the interest rate had gone down. The pensioners were crying that now earlier it was 9%, now we are getting 6% or 7%. We only get pension and that is deposited in the bank. We hardly get any amount, and if at all we get an amount, we have to pay income tax on that, except on saving account. Now they need not put it in saving account, put it in FDRs or sweep account. 50,000 rupees deduction per year. And no TDS under 194A up to 50,000. It was 10,000, but for this senior citizen, now no TDS for this interest, whether on fixed deposit or recurring deposit or a saving bank, up to 50,000. A great relief for senior citizen, but this is under 80TTB, new section inserted, and there is no need to file a return of income before the due date because that comes under 80C, that comes under 80CA. So for 80TTA, 80TTB, 80U, even if you file return of income late, yes, penalty will be leviable, but deduction will be allowed because it is not covered under Part C, it is covered under Part CA of the deduction. So please, you can file return late, but you are liable for penalty. Don't tell me later penalty is 5,000 or 10,000 as the case may be. Next section. I told you that when there is a conversion of inventory into capital asset, there will be a business income. So once it is a business income, now you have created a capital asset, the question will arise, what will be the cost of acquisition of that capital asset? One, that has been held under section 49 subsection 6 inserted. And the question will arise, what will be the period of holding of that capital asset if I want to earn capital gain on that capital asset? On that capital asset. Please note, the cost of acquisition will be the fair market value which you have determined for the purpose of treating the income under business head. Whatever was the income under business at the fair market value, the same fair market value will become the cost of acquisition of that asset which has been converted for inventory to capital asset. Second point, period of holding. It will not be period of holding of the inventory. Period of holding will be date of conversion into a capital asset. Section 2, clause 42A, explanation, period of holding, I have told you. Section 49, subsection 2, cost of acquisition of that asset, I have told you. This is going to be the case as regards, I told you, I'll tell you later, this is going to be the case for that. Coming to now, a very important point. It's not confusing, but you have to understand. 1038 abolished. 1038 means long-term capital gain from transfer of share quoted through on which security transaction tax has been paid was earlier exempt under 1038, not only the shares but also the units of the equity-oriented fund. Sunset clause. No transaction after 1418 will be eligible for 1038. New section added. 112 subsection A, 112 capital A. Please note, 112 is taxation of long-term capital gain. Now it is 112 capital A. What does it say? Notwithstanding anything contained under section 112. 112 says 20%, 112 says 10% without indexation, 20%. Notwithstanding that, if there is a transfer of shares or unit of the equity-oriented fund, and there is a capital gain. There is a capital gain. That capital gain is a long-term capital gain. And on which, please note the word, if it is share, security transactions should have been paid at the time of acquisition as well as at the time of transfer. STT has to be paid. Last year it came that if you have acquired any asset on or after 1/10/2004, then STT is compulsory unless that exception has been given in a notification. That notification stands. Otherwise, if you have acquired any share on or after 1/4/2004 by paying STT and you also pay tax STT at the time of transfer and there is a long-term capital gain, now this long-term capital gain will be taxable from assessment year 2019-20 at a special rate of 10%. At a special rate of 10%. And mind it, you will not be given a benefit of Proviso 1 and Proviso 2 of Section 48. What is Proviso 1 and Proviso 2 of Section 48? In case of non-resident, you are allowed to take the convert into foreign currency, no benefit. In the case of Proviso, indexation is allowed. But in this case, you will not be entitled to indexation. You will not be entitled to indexation, let me tell you. You will not be entitled to indexation. So always capital gain will be 10% of the sale price minus the cost of acquisition. But now grandfathering. the benefit given to us is this. When you calculate capital gain, long term, you have to deduct from consideration price the cost of acquisition. So what is the cost of acquisition? The question is, what is the cost of acquisition? Now I am taking you to cost of acquisition defined under section 112A7. What it says, it will be higher of the two things. Please, higher of A and higher of B. Higher of two, A, B. But wait, forget about A. Let us come to B. B has two parts. B has I, 2I. Lower of the I, 2I. First you calculate lower of the I and 2I. I am starting from B. Lower of the 2. What is I? I says the market value of share as on 31st January 2018. Market value. Fair market value. On which date? Yesterday. 31st January 2018. Or the sale price, whenever you sell, the sale price of that share, whichever is lower. This is clause B. Lower of the two things. What is lower? Market value as on 31st January or the sale price whenever you are going to sell it. Whenever you are going to sell it. And there is a long-term capital gain. Suppose the market value is 150 rupees and the sale price is 140. The lower is 140. Market price is 150. Sale price is 200. The lower of that is 150. Done? This is clause B. Take the lower of the two. Now clause A. Higher of the clause A and B. Higher of clause A and B. What is A? Actual cost of acquisition. So actual cost of acquisition or lower of the I and 2I. Whichever is higher. So let me take an example. Suppose you bought a share for 120 rupees. Cost. 31st January. The price is 150 rupees. 120 bought, 31st January 150 rupees. You sold it for 200 rupees. First, go to B. 150 or 200, whichever is less. 150. Right? Now go to A. 100 rupees. 120 rupees, sorry. So 120 rupees or 150, whichever is higher. So 150. My cost of acquisition will be 150 rupees. Meaning thereby, whatever gain I have earned till 31st of January will be exempt. Will be treated as cost. Whatever gain I have earned from the date of purchase till 31st January, that gain will not be taxable at all. In future also will not be taxable if I have acquired before 31st January. If I have acquired after 31st January, there is absolutely no problem. But please note, don't take the A first. Go to B, and in B, take higher of the lower of the two. What is lower of the two? Market value on 31st January or the sale price. Lower of the two. The benefit is, if there is a loss, there cannot be a loss in this case. There will not be a loss because you have to take higher of the two as the cost. So question of loss is not there, but profit you will always get. Exemption to the extent of the market value as on 31st January. So it is a good proposal, but of course now they have introduced it. It is a permanent thing and no indexation. It is not before bought. Any time later also bought. No indexation, always taxable at 10%. Something very surprising, always taxable at 10%. Only one exception is that it will be taxable at 10% of a long-term capital gain exceeding rupees 1 lakh. Up to 1 lakh, no problem. If the long-term capital gain exceeds 1 lakh, on the excess amount, you have to pay 10%. 1 lakh, the exemption is going there. You have to pay on the excess amount 10% and not any other amount. So this is the proposal. I don't want to change my FI were taxable at 10%, but now long-term capital gain is taxable. This under 115 AD, the FII will also be taxable at the rate of 10% with the long-term capital gain from transfer share. That is 115 AD. Very important change. And let me tell you, we will be put into a lot of difficulties now. We
We had a section called Section 2, Clause 22, Clause E as a deemed dividend, saying that where any loan or advance is given by a closely held company to a shareholder who holds 10% voting power in the company, or to a concern where such shareholder has 20% voting power, the amount was treated as deemed dividend in the hands of the shareholder. Please note the word loan or advance given by a closely held company to a shareholder who holds 10% voting power, or to a concern in which such a shareholder who holds 10% holds 20% voting power. देखिए 10 and 20, 10 this side, 20 this side. It was treated as deemed dividend in the hands of the shareholder. To the extent of accumulated profit exclusive of capitalized profit. To the extent of accumulated profit exclusive of capitalized profit. Please note, now this loan or advance will be treated as dividend distributed by the company. Dividend distribution tax will have to be paid by the company and not the shareholder. Earlier it was treated as a dividend, deemed dividend in the hands of the shareholder. Now it will be treated as a dividend declared and distributed by the shareholder, although he is given loan or advance. The company will have to pay tax, not that 15% or grossing above 15%. Company will have to pay tax at the rate of 30% without grossing. Because in the case of deemed dividend, 2 to 150, no, the grossing is done, which comes to not 15%, 20.359%, something like that. This will be 30% gross. Who will pay? Company. Dividend distribution tax has to be paid within 14 days of the declaration, distribution or payment. This is payment. Loan advance is a payment. You will have to pay 30% within 14 days of that loan or advance. The difficulty is there are many judgments which says if the loan or advance has been given for business purpose, it is not treated as a loan or advance. If it is amount is given for business purposes, there are many disputes on this. Now, instead of the shareholder, the company will be caught and company will be treated as deemed to be default. They have not paid the tax of 30% on such loan or advance. One more change in 222. You know, earlier, 222A, B, C, D, accumulated profit have to be calculated till the date of distribution. Till the date of distribution. Now, the accumulated profit was only of that company. Now they have said if there is a merger, if there is an amalgamation, accumulated profit of the amalgamated company shall also include the accumulated profit of the amalgamating company. Or if there is a loss, it will. So the point is, now that the person who used to avoid tax by merger and all that, they will be put into difficulty, because now accumulated profit will be of the amalgamated company, including the accumulated profit of the amalgamating company. So this is another issue which I wanted to tell you. A wonderful change, 115 JB, again for insolvency provision, those persons who are going for insolvency. Why that resolution, insolvency resolution? Because 115 JB, you are allowed, to deduct brought forward loss or unabsorbed depreciation, whichever is less. Brought forward loss or unabsorbed depreciation, whichever is less. For insolvency personnel, for 115 JB, you will be allowed a deduction on account of brought forward loss and unabsorbed depreciation. It's not or. It's not whichever is less. Both deduction will be allowed. So beneficial person, they will not have to pay MAT in that case. They will not have to pay MAT on that brought forward loss or what you call the unabsorbed depreciation. A complicated thing, but it can be understood. Next point. He pointed out yet 139, a permanent account number will have to be applied by everybody who is going to a financial transaction for 2,50,000 per year or more. They will have to apply for PAN, otherwise you will be liable for penalty which is there for not applying PAN, 10,000 rupees. You will have to make an application if you are going for a financial transaction of rupees 2,50,000 more in a year. That is another point added under section 139A subsection 1. Next point. Even in case of equity-oriented fund, if you remember, dividend distribution tax was not there. If a mutual fund or equity-oriented fund, no dividend tax was there. Now they have introduced dividend distribution tax in case under 115 are also in the case of equity-oriented fund also. Market will have a repercussion on this. Later you will come to know. Next point. The next point which I want to tell you is very important, I tell you. There is a, section 285BA where you have to pay, we used to call it as annual information return. Now it is not called annual information return, it is called a statement of financial and reportable account if I am not wrong. And I think it has to be filed by 31st of August of every year. Earlier the penalty for delay in filing was 100 rupees per day for each day of default. And if notice had come to you to file, then it was 500 rupees per day for each day of default. Now, section 271 FA has been changed. If you do not file the annual information return, that is statement of financial and reportable account, by that specified date, the penalty will not be 100 rupees per day, it has been raised to 500 rupees per day of delay in filing AIR. And if you got a notice to file the reportable account for any reason, then the penalty will be 1,000 rupees per day instead of 500 per day. This is the penalty which has been introduced under section 271 FA. Penalty was already there, 100 raised to 500, 500 raised to 1,000. So this is also, and one that is International Financial Center. You know, they were liable to 115 JB at the rate of 9% instead of 18%. But in AMT, it was not 18.5. They have brought down to 9% also in case they are under alternate minimum tax. AMT, minimum alternate tax, last year it was 9%. Now alternate minimum tax is also now brought down to 9% in case of International Financial Center. That also is a change which has taken place, may not be much interest to you, but of course I have to tell you when it is there. One more change which very rightly pointed out by Mr. Tarun Ghia, that the companies were not filing return, saying that they don't have a taxable income, they don't have any income, so where is the tax liability? So only thing was the penalty. But because under section 276 CC, the prosecution was only then when the tax payable was minimum 3,000. Am I right, sir? 3,000. Now that has been deleted for a company. So even if no tax is payable, if they don't file a return, prosecution can be launched against the company. That means all those companies, those who are not filing return, say what can they do maximum? Put a penalty on us. Now prosecution can also be launched against those companies which are avoiding to file a return, saying that they don't have any tax to pay, so what is the need of filing a return? Now they will have to file a return. I think I have covered almost everything. And the time, of course, permits us to talk about some other thing. If there are queries, are there queries there?
Yeah.
So we will be taking up I am handing over the mic to Sanjay Agarwal. If any queries there, we will definitely reply.
Thank you, sir. There are
introduced from assessment year 1920. So mind this thing. Now, if you sell it after 31st March and if there is a loss, definitely, since capital gain is taxable, if there is a loss, a long-term capital loss, it will also be allowed to be set off from long-term capital gain of any nature, not of this, any nature. But long-term capital loss from the shares which had taken place after 31st March 2018, on which STT has been paid. Loss allowed can be set up from long-term capital gain.
Not if I give you an example, in 17-18 assessment year, I have a short-term loss. And now I sell my share after first.
Correct.
Then I have a
brought forward short-term capital loss can be set up either from short-term capital gain or long-term capital gain at the option of the assessee. So absolutely no problem, but don't create a short-term capital loss. Please don't create genuine loss.
So there is no change in the provision.
Correct. No, that provision is the stands as is. That section 71 stands as it is. Section 70 no change, 71 no change, 74 no change. 74 is the change for capital loss, no change at all.
Viewers, I am not taking those queries for which elaborate answers or elaboration has already been given by Guruji.